Hello and welcome to a discussion that provides an overview of the direct and indirect methods used to prepare the operating section of the cash flow statement. It is important that you view this before class so we can learn more together in class. After viewing this video, you will be able to state the difference between the indirect and the direct cash flow statement, and also state the line items that are reported on the direct statement and the indirect statement. U.S. Generally Accepted Accounting Principles gives a company the choice of presenting the indirect or the direct method of the cash flow statement. Almost all U.S. companies currently use the indirect method. On the contrary, international companies generally provide the direct cash flow statement. The direct method states the amount of cash that is collected and the amount of cash that is paid for specific items during the period. There is no reconciliation to net income, and all amounts represent cash that was paid or received. You are looking at the format of the direct method cash flow statement. Notice it states the items of cash collections and the items cash is paid for related to revenues and expenses reported on the income statement. The amounts represent cash paid and received only. The amounts paid and received for cash must be computed using formulas. Start with the items reported on the income statement and adjust for amounts that were included in net income that were not cash. Let's discuss the first formula. Revenues that are included in income and not collected are receivables. The change in the receivable represents the difference in the current period revenue and the amount that was collected in the current period. Assume the beginning receivables were collected and the ending receivables were not collected. Revenues are always matched with the receivable to determine how much cash was collected. Cost of goods sold is matched with inventory and accounts payable. Changes in inventory affect cost of goods sold, and accounts payable states whether or not the inventory was paid for in the current period. Assume beginning inventory was paid for in the prior period and ending inventory was paid for in the current period. Then assume beginning accounts payable was paid for in the current period and the ending accounts payable was not paid in the current period. The total is the cash paid to suppliers, mostly for inventory, in the current period. All other current liabilities and prepaid expenses are matched to the associated expense to determine how much cash was paid in the current period. The formulas are always income statement account plus beginning minus ending unless an expense is matched with an asset. The indirect method starts with net income and considers items that represent amounts included in net income. Some revenues are not collected in cash this period or in future period. Some expenses are never paid in cash in the current period or future periods. Gains and losses are the net of the asset and the cash and do not equal the cash received from the sale. Current asset and current liability accounts are necessary because cash did not occur in the same period as the revenue or expense. Accounts receivable is used when cash was not received in the same period as the sale. Prepaid expenses represents cash paid in periods before the expense was incurred. Payable accounts represent cash that will be paid after the period the expense is incurred. Current assets and current liabilities represent differences in the cash and the amount included in net income. Net income is adjusted for items that were included in net income that did not also have cash paid or received in the same period. Here is an example of the operating activities section of an indirect method cash flow statement. Notice it begins with net income, is adjusted for non-cash items, and is adjusted for changes in current assets and current liabilities. Depreciation expense is added because it is an expense that reduced net income that was not paid. Therefore, there is more cash than net income. The gain is subtracted from net income because it increased income, however, cash was not received, so cash is less than net income. The negative accounts receivable represents an increase in accounts receivable. The sales increase net income. However, the increase in accounts receivable represents cash was not received. The positive income tax payable indicates that cash is higher than income because part of income tax was not paid in the current period. The negative accounts payable represents more cash was paid than the expenses that were included in net income. It is possible to pay more than the current period expense if you are also paying for prior period expenses. The positive or negative number means the amount of cash is higher or lower than the revenue or expense included in net income. The indirect method begins with net income and is adjusted for items included in net income that did not change cash. Non-cash expenses and losses are added to net income because they were not paid and therefore there is more cash. Non-cash revenues and gains are subtracted from net income because no cash was received and therefore there is less cash. An increase in a current asset indicates cash was paid before the expense was incurred and there is less cash, so subtract it. A decrease in a current asset can be viewed as the asset was sold, therefore it is an increase to cash. Liabilities work opposite of assets. An increase in a current liability indicates cash was not paid, and therefore the company has more cash. A decrease in a current liability indicates more cash was paid than the expense, therefore the company has less cash. Net income plus or minus all the items that represent differences in the amounts included in net income and the cash paid. There are times when the depreciation expense and the gain or loss is not given. In this case, the amounts must be determined by making journal entries and using T accounts to locate the differences. Depreciation expense and selling an asset are the two transactions that change the accumulated depreciation account. If you know the beginning and the ending balance and one of the two other transactions, you can plug the amounts and determine the other amount. You will generally be given the amount of accumulated depreciation sold and have to plug for depreciation expense. Gains and losses are generally determined by recording the journal entry for the sale using the additional information provided. After viewing this video, you will be able to state the difference between the indirect and the direct cash flow statements. You should also be able to state the lines that are reported on the direct method cash flow statement and the indirect method cash flow statement. The next video will discuss the investing and financing activities section of the cash flow statement. Thank you for being prepared for class. It is much appreciated.